Section 3.1 to 4.3 Technical Analysis for Active Investing, Active Investing, Strategies for Beating the Market. 3.1 Introduction to Technical Analysis. Technical analysis is an approach to analyzing financial markets and making investment decisions based on the study of historical price and volume data. It assumes that market trends, patterns, and behavior repeat over time and that these patterns can be used to predict future price movements. Here are some key principles and assumptions of technical analysis. Price discounts everything. The central principle of technical analysis is that all relevant information about a security, including fundamental factors, market psychology, and external influences, is reflected in its price. Technical analysts believe that the price already incorporates all available information, making the study of price patterns and trends sufficient for making investment decisions. Market trends exist. Technical analysts assume that markets move in trends, which can be upward, bullish, downward, bearish, or sideways, consolidation. They believe that these trends persist over time and that analyzing them can provide insights into future price movements. History repeats itself. Technical analysis is based on the assumption that market behavior repeats itself due to human psychology and market participants' collective actions. Patterns that have worked in the past are expected to work again in the future. Technical analysts use historical price data to identify recurring patterns and use them as indicators of future price movements. Support and resistance levels. Technical analysts believe that price levels where buying interest is strong enough to prevent further price declines, support levels, and price levels where selling pressure is strong enough to prevent further price increases, resistance levels, can be identified. These levels are often determined by previous price highs and lows and are considered important reference points for future price movements. Technical indicators. Technical analysis uses various indicators and tools to analyze price data and generate trading signals. These indicators include moving averages, oscillators, trend lines, volume analysis, and more. They provide additional insights into market trends, momentum, overbought or oversold conditions, and potential turning points, patterns and chart analysis. Technical analysts study price charts and patterns to identify potential trading opportunities. Chart patterns, such as triangles, head and shoulders, double tops or bottoms, and trend channels, are believed to provide signals about the future direction of prices. These patterns are formed by price and volume data and are interpreted to forecast potential breakouts, reversals, or continuation of trends. Timeframe selection. Technical analysis can be applied to various timeframes, ranging from intraday charts to long-term charts. The choice of timeframe depends on the investment horizon and trading style of the analyst. Short-term traders may focus on shorter time frames, while long-term investors may analyze longer-term charts to identify major trends and support their investment decisions. Limitations and criticisms. Technical analysis has its limitations and critics. It is often criticized for its subjective nature, as different analysts may interpret the same data differently. Critics argue that technical analysis does not consider fundamental factors, economic data, or company-specific information, which may be crucial for long-term investment decisions. Additionally, the efficient market hypothesis suggests that it is not possible to consistently outperform the market using technical analysis alone. It's important to note that technical analysis is one of the approaches used in financial analysis and investment decision-making. Many investors combine technical analysis with fundamental analysis and other tools to gain a more comprehensive understanding of the markets and make well-informed investment decisions. Chart patterns, trends, and indicators are essential components of technical analysis. They provide insights into market behavior, potential price movements, and trading opportunities. Here's an overview of each. Chart patterns. Chart patterns are recognizable formations on price charts that indicate potential trend reversals, continuations, or breakout opportunities. Some common chart patterns include head and shoulders. This pattern consists of a central peak, the head, flanked by two smaller peaks, the shoulders. It suggests a potential trend reversal from bullish to bearish, double top/bottom. These patterns occur when the price reaches a high point, double top, or a low point, double bottom, twice before reversing. They can indicate a potential trend reversal. Triangle patterns. Triangles form when the price consolidates, creating a pattern resembling a triangle. They can be symmetrical, price range narrows, ascending, higher lows and flat tops, or descending, lower highs and flat bottoms. Breakouts from triangle patterns are often seen as potential trend continuation signals. Flags and pennants. These patterns occur when the price experiences a brief consolidation, flag, or a small symmetrical triangle, pennant, within a strong trend. They are considered continuation patterns. Wedges. Wedges form when the price consolidates between two converging trend lines. They can be ascending, higher lows and higher highs, or descending, lower highs and lower lows. Wedges can indicate potential trend reversals or continuations. Trends represent the general direction of price movements over time. They can be categorized as uptrend. Higher highs and higher lows characterize an uptrend. It indicates a bullish market where buyers are in control. Downtrend. Lower highs and lower lows characterize a downtrend. It indicates a bearish market where sellers are in control. Sideways/consolidation. Sideways or consolidation trends occur when the price moves within a range, with no clear upward or downward direction. It suggests a balanced market with supply and demand in equilibrium. Identifying and following trends can help traders and investors make decisions aligned with the current market sentiment. Indicators. Technical indicators are mathematical calculations derived from price, volume, or other market data. They are used to analyze market conditions, identify potential entry or exit points, and confirm or contradict chart patterns. Some common indicators include moving averages. MAs smooth out price fluctuations and provide an average value over a specific period. They help identify trends, support and resistance levels, and potential reversals. Relative Strength Index, RSI. RSI measures the speed and change of price movements to determine overbought and oversold conditions. It ranges from 0 to 100 and is often used to indicate potential trend reversals. Moving Average Convergence Divergence, MACD. MACD is a trend-following momentum indicator that helps identify potential buy or sell signals. It consists of two lines, the MACD line and the signal line, Bollinger Bands. Bollinger Bands consist of a moving average, an upper band, and a lower band. They help determine volatility, overbought or oversold conditions, and potential price breakouts. Volume. Volume indicators analyze the trading volume associated with price movements. They can provide insights into the strength of a trend, potential reversals, or the confirmation of price patterns. These are just a few examples of the numerous indicators available. Traders and investors often use a combination of indicators to gain a comprehensive view of the market and make informed decisions. It's important to note that chart patterns, trends, and indicators are not foolproof and should be used in conjunction with other analysis techniques and risk management strategies. Additionally, it's crucial to understand the limitations and potential biases of technical analysis and consider other factors such as fundamental analysis. Market conditions and investor sentiment. 3.2 Momentum and trend following strategies. Momentum indicators are widely used in technical analysis to identify trends, gauge the strength of price movements, and find potential trading opportunities. These indicators help traders identify situations where prices are overbought or oversold, signaling potential reversals or continuation of trends. Here are some commonly used momentum indicators and how they can be utilized. Relative Strength Index, RSI. RSI is a popular momentum indicator that measures the speed and change of price movements. It oscillates between 0 and 100. A reading above 70 is typically considered overbought, indicating that the price may be due for a correction or a reversal to the downside. Conversely, a reading below 30 is generally considered oversold, suggesting that the price may be due for a bounce or a reversal to the upside. Traders often look for bullish or bearish divergences between the price and the RSI, which can provide early indications of potential trend reversals. Moving Average Convergence Divergence, MACD. MACD is a trend-following momentum indicator that consists of two lines, the MACD line and the signal line. The MACD line is calculated by subtracting a longer-term exponential moving average, EMA, from a shorter-term EMA. The signal line is typically a 9-day EMA of the MACD line. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting a potential uptrend. Conversely, when the MACD line crosses below the signal line, it generates a bearish signal, suggesting a potential downtrend. Traders also look for bullish or bearish divergences between the MACD and the price, which can indicate potential trend reversals. Stochastic oscillator. The stochastic oscillator is another popular momentum indicator that compares a security's closing price to its price range over a specific period. It consists of two lines, the %K line and the %D line. The %K line is more sensitive and oscillates between 0 and 100, while the %D line is a smoothed version of the %K line. Similar to the RSI, readings above 80 are generally considered overbought, suggesting a potential reversal to the downside, while readings below 20 are considered oversold, suggesting a potential reversal to the upside. Traders look for bullish or bearish divergences between the stochastic oscillator and the price to identify potential trend reversals. Average directional index, ADX. The ADX is used to determine the strength of a trend rather than its direction. It ranges from 0 to 100. A high ADX reading indicates a strong trend, while a low ADX reading suggests a weak or non-existent trend. Traders can use the ADX to filter out trades during range-bound markets and focus on trading opportunities during trending markets, when utilizing momentum indicators. It's important to consider them in the context of the overall market conditions, price patterns, and other technical indicators. It's also crucial to practice proper risk management techniques, including setting stop-loss orders and position sizing, to protect against potential losses. Additionally, it's recommended to combine momentum indicators with other technical analysis tools and strategies for a comprehensive approach to trading. Implementing trend-following strategies for active investing involves identifying and capitalizing on market trends. Here are some key steps to consider when implementing trend-following strategies. Define the trend. Determine the direction of the trend by analyzing price charts and indicators. Look for higher highs and higher lows in an uptrend or lower highs and lower lows in a downtrend. Consider using trend-following indicators such as moving averages or trend lines to identify the trend direction. Select a timeframe. Choose a timeframe that aligns with your investment goals and trading style. Short-term traders may focus on intraday or daily charts, while long-term investors may analyze weekly or monthly charts. Ensure that the chosen timeframe suits your risk tolerance and trading horizon. Confirm the trend. Use additional indicators or tools to confirm the presence of a trend and filter out potential false signals. For example, you can use a combination of moving averages, trend lines, or trend-following oscillators, such as the average directional index, ADX, to confirm the strength and sustainability of the trend. Entry and exit strategies. Define clear entry and exit rules based on the identified trend. For example, you may choose to enter a long position when the price breaks above a moving average or a significant resistance level. Conversely, you may exit the position if the price falls below a specific support level or when a trend reversal signal is generated. Consider using stop-loss orders to manage risk and protect against significant losses. Position sizing and risk management. Determine the appropriate position size based on your risk tolerance and the potential risk-reward ratio of the trade. Apply proper risk management techniques, such as setting a maximum percentage of capital at risk per trade or using trailing stops to lock in profits as the trend progresses. Monitor and adjust. Continuously monitor the market and adjust your positions or strategies as the trend evolves. Stay updated on relevant news, economic events, or company-specific developments that may impact the trend. Regularly review and analyze your trades to learn from both successful and unsuccessful trades and refine your trend-following strategy over time. Combine with other analysis techniques. Consider integrating trend-following strategies with other analysis techniques, such as fundamental analysis or other technical indicators, to gain a more comprehensive view of the market. This can help validate trade ideas and increase the probability of successful trades. Backtesting and evaluation. Before implementing a trend-following strategy, conduct backtesting to assess its historical performance. Use historical price data to simulate trades and evaluate the strategy's profitability, risk-adjusted returns, and drawdowns. This can provide insights into the strategy's effectiveness and help identify potential areas for improvement. Remember that trend-following strategies do not guarantee successful trades in all market conditions. Markets can be volatile, and trends can reverse unexpectedly. It's important to diversify your portfolio and manage risk by allocating capital across different assets and strategies. Additionally, consider seeking advice from financial professionals or conducting further research to tailor trend-following strategies to your specific investment goals and risk appetite. Section 4, Active Investing Approaches, 4.1 Sector Rotation Strategies. Sector rotation strategies involve shifting investments among different sectors of the economy based on the expectation of changes in economic conditions or business cycles. The aim is to capitalize on the outperformance of certain sectors during specific phases of the economic cycle. Here are some benefits and considerations of sector rotation strategies. Diversification. Sector rotation strategies provide diversification benefits by allocating investments across different sectors. By spreading investments across multiple sectors, investors can reduce their exposure to specific industries or companies, potentially mitigating risk. Potential for outperformance. Different sectors tend to perform better in different stages of the economic cycle. For example, during an economic expansion, cyclical sectors like technology, consumer discretionary, and industrials may outperform, while defensive sectors like utilities and consumer staples may perform better during economic downturns. By rotating investments into sectors expected to outperform in the current economic environment, investors have the potential to achieve above-average returns. Flexibility and adaptability. Sector rotation strategies allow investors to be flexible and adapt to changing market conditions. As economic conditions evolve, sectors that were once performing well may start to lag, while previously underperforming sectors may start to shine. Sector rotation strategies enable investors to reallocate their investments accordingly and take advantage of shifting market dynamics. Active management opportunity. Sector rotation strategies require active management and ongoing analysis of economic data and sector trends. This presents an opportunity for active investors to use their research and analysis skills to identify sectors that are poised for growth and adjust their portfolios accordingly. Active management can potentially lead to better investment decisions and enhanced returns. Potential for enhanced risk-adjusted returns. If executed effectively, sector rotation strategies have the potential to generate enhanced risk-adjusted returns. By investing in sectors that are expected to outperform and reducing exposure to sectors that are expected to underperform, investors can potentially improve the risk-reward profile of their portfolios. It's important to note that sector rotation strategies also come with certain considerations and challenges. Market timing. Successfully timing market cycles and accurately predicting sector outperformance can be challenging. Economic cycles can be difficult to forecast, and sector performance may not always align with expectations. Mistimed rotations can result in missed opportunities or subpar returns. Research and analysis. Implementing sector rotation strategies requires in-depth research and analysis of economic indicators, sector fundamentals, and market trends. It requires ongoing monitoring and staying updated with changing economic and sector-specific factors, transaction costs and taxes. Frequent buying and selling of sector-specific investments can lead to increased transaction costs, such as brokerage fees, bid-ask spreads, and taxes on capital gains. These costs can eat into investment returns and should be considered when implementing sector rotation strategies. Risk of overconcentration. Sector rotation strategies may result in overconcentration in specific sectors, which can increase portfolio risk. If the anticipated sector outperformance fails to materialize or if a sector experiences unexpected challenges, the portfolio may be negatively impacted. As with any investment strategy, it's important to thoroughly understand the risks, conduct proper research, and consider individual financial goals, risk tolerance, and investment time horizon when implementing sector rotation strategies. It can be beneficial to consult with a financial advisor or investment professional to determine the suitability of such strategies for your specific circumstances. Identifying sectors with growth potential requires careful analysis of various factors, including macroeconomic trends, industry dynamics, technological advancements, regulatory changes, and consumer behavior. Here are some steps to consider when identifying sectors with growth potential and rotating investments accordingly. Macro-level analysis. Start by analyzing macroeconomic indicators and trends. Look for countries or regions experiencing strong economic growth, favorable demographic trends, stable political environments, and supportive monetary or fiscal policies. These factors can create a conducive environment for sector-level growth. Industry analysis: dive deeper into specific industries to identify sectors that are likely to experience growth. Consider factors such as market size, demand-supply dynamics, technological innovations, regulatory environment, and competitive landscape. Look for sectors that are positioned to benefit from emerging trends or disruptive technologies. Top-down and bottom-up approach: adopt a top-down and bottom-up approach to sector analysis. Top-down analysis involves assessing broad economic trends and then narrowing down to specific sectors. Bottom-up analysis involves evaluating individual companies within a sector to identify those with strong growth prospects. Combining both approaches provides a comprehensive view of the sector's growth potential. Fundamental analysis: conduct fundamental analysis of companies within the sectors you are considering. Evaluate financial metrics such as revenue growth, earnings growth, profitability, cash flow generation, and return on investment. Assess factors like competitive advantage, market share, management quality, and future growth catalysts. This analysis will help identify companies with solid growth prospects within the chosen sectors. Market sentiment and investor behavior: consider market sentiment and investor behavior when assessing sector growth potential. Market sentiment can influence sector performance, and understanding investor sentiment can provide insights into market expectations and potential opportunities. Monitor investor flows, analyst reports, and market news to gauge sentiment towards specific sectors. Long-term trends and disruptions: identify long-term trends and disruptions that can drive sector growth. Consider areas such as renewable energy, e-commerce, artificial intelligence, healthcare technology, cybersecurity, and other emerging industries. These sectors may benefit from long-term societal or technological changes, offering growth potential. Regulatory and policy changes: evaluate regulatory and policy changes that can impact specific sectors. Changes in regulations can create growth opportunities or pose challenges for certain industries. Stay informed about government policies, legislative developments, and geopolitical factors that can shape sector growth prospects. Monitor sector performance: continuously monitor the performance of sectors and individual companies within those sectors. Stay updated with quarterly earnings reports, industry news, and economic indicators to identify shifts in sector dynamics or performance. Regularly review your portfolio and make necessary adjustments to rotate investments based on changing growth prospects. Remember that sector rotation involves active management and regular monitoring of sectors and individual stocks. It requires keeping abreast of changing market conditions and adjusting portfolio allocations accordingly. It's important to conduct thorough research, diversify investments across sectors, and carefully consider risk management techniques to mitigate potential downside risks. Lastly, consider seeking advice from financial professionals or investment advisors who specialize in sector analysis and have expertise in identifying sectors